Okay, in this video, I am going to try and describe, actually, I'm not going to try, I am going to describe the time value of money, and we need to understand the time value of money before we can start moving into how we would value or determine the issue price of a bond, okay? So the time value of money, what we're saying is assume that I have $10,000 today, okay? And I'm going to put that in the stock market and it's going to earn 10%, okay? It's just going to grow by 10%. At the end of 1 year, I'm going to have $11,000, right? I'm going to have the original $10,000 and then my investment is going to grow by 10% or $1,000. So at the end of the first year, I'll have $11,000. Then at the end of the second year, let's just assume I keep it in the stock market and it grows another 10%, right? At the end of the second year, believe it or not, I can't do that in my head. So at the end of the second year, I'm going to have 12,100, right? So 10% on top of the 11,000 I had the previous year, which means I just earned 1,100. And let's just do it one more year. Let's say that I keep it in there another year, it grows at another 10%. My 12,100 is going to turn into, and you guessed it, it grows into 13,310. Okay? I start with 10,000, I put it in the stock market for 3 years and it grows by 10% every year, and therefore at the end of 3 years my 10,000 turns into 13,310. All right? So now the conceptual issue in this chapter that we need to understand is that if I say to you, hey, you know what? 3 years from now, I will give you $10,000. Okay? We now know that $10,000 3 years from now isn't actually worth $10,000 today. Because if I had $10,000 today, I could grow it in the stock market for 3 years at 10% and it would be worth 13,300. So I'm going to go the opposite direction and I'm going to assume that I have some amount of money today and I'm going to put that in the stock market and that's going to grow at 10% every year. And at the end of 3 years, I will have $10,000. So the question is, how do I work backwards, right? So the way that we work backwards, the formula is just going to be 1 over 1.1. Okay, so if I do that math, I went ahead and did all of the math for us, right? So again, we're essentially saying here that if I had 7,000, well, let me work backwards. We're essentially saying that, look, I'm going to have something here that's going to grow to 10,000 a year from now. So how do I work backwards, assuming that I'm going to earn 10%? And like I was saying, the formula is 1 over 1 plus the interest rate. And since the interest rate's 10%, it's 1 over 1.1, otherwise known as 91%. So I multiplied 10,000 times 91% to get 9,100. Then I'm going to do it again. I'm going to go backwards by 10%, meaning I'm going to multiply 9,100 times 91%, and I'm going to get 8,281. And then finally, I'm going to do it one more time. I'm going to discount everything at 10%, which means that I am going to multiply 8,281 times 91%, and I end up with 7,536. So what we're saying is, if I have $7,536 today, then I could put that in the stock market and it would grow by 10%. And after 1 year, I would have 8,281. Then I could leave it in there again a second year and it would grow to 9,100. And then finally, I would leave it in there that last year and my 9,100 would then grow to 10,000. Okay. So 10,000 a year from now, sorry, 10,000 3 years from now is worth something much less today. And 10,000 today is worth something much more 3 years from now. This is the time value of money, and it's a super powerful tool. And we need this tool in order for us to figure out how we value a bond. And so I'm going to, in the next video, talk about how we value bonds using the time value of money concept.